Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't have to, and today we are talking about the top 3 best growth stocks to buy in February of 2022. I'm also going to talk about one bonus stock at the end of the video, so we are going to have 4 growth stocks in total by the end of the video. Many top growth stocks have been falling as of late, and to me this offers investors a fantastic buying opportunity as long as we buy strong companies that have solid fundamentals. So the 3 companies that we're going to be talking about initially, and then one bonus company at the end, is going to be Cresco Labs, Shopify, and Walt Disney. Cresco Labs, ticker symbol CRLBF, currently trades for $6.69. The low-end price target, according to analysts, in the next 12 months is $14 per share. The average price consensus is $16 per share, and the high-end price target among analysts is $19, which the stock can reach in the next 12 months. Currently, I researched 15 analysts that cover this stock, and 14 of the analysts gave it a solid buy rating, while one analyst said that Cresco Labs is a fantastic company to hold for future growth, and no analyst that I researched said to sell this company. For Shopify, ticker symbol SHOP, the current stock price is $829 per share, and if that looks daunting, you can always invest in this company through fractional shares if you have a brokerage such as Robinhood or Webull. The low-end price target among analysts is $900. The average price consensus for the next 12 months for this stock is $1,523, which provides fantastic upside from the stock's current price, and the high-end price prediction is $2,000 per share. I researched 45 analysts that currently cover the stock. One analyst had a sell rating. 19 analysts said to hold this stock so the company can grow more into its overall valuation, and 25 analysts of the 45 said this stock is a fantastic buying opportunity right now. Then we have Walt Disney, ticker symbol DIS, and Walt Disney stock currently trades for $140 per share. The low-end price target is $126, so ideally we would want the current stock price to be below the low-end price prediction of $126, but we'll take what we can get. The average price target among analysts is $194, and the high-end 12-month price target for Disney stock is $220 per share. I researched a total of 33 analysts that currently cover this stock. 26 of them said to buy Disney, 7 said to hold Disney, and none of them said to sell DIS stock. So now that we know the companies that we're talking about, let's talk about what they do, their financial projections, some of their fundamentals, and their overall business. As you can see from the chart down below to the left, we can see that Cresco Labs, Shopify, and Walt Disney have all dropped respectively over 20%. Specifically, if we look at Shopify, Shopify has dropped around 47% literally within the past 6 months. If we move up to Cresco Labs has dropped almost 40% in total, and Walt Disney has dropped a little above 20%, dropping at a rate of 23%, while compared to the S&P 500, which is our stock market benchmark, that has only dropped around 1.4% recently. This means that growth investors should take advantage of these major stocks pulling back because the overall companies and the fundamentals of these companies, to me, are absolutely phenomenal. So now let's start talking about these specific companies. Cresco Labs is a marijuana company, and the marijuana industry in the United States is set for extreme growth. This is despite overall international legalization of marijuana, which has not taken place yet, but even if it doesn't take place in the next decade, this sector is absolutely primed for fantastic growth. Even the overall global marijuana market is anticipated to grow at an annual compounding growth rate of 22%, which is absolutely phenomenal, which means that the overall global market for marijuana products is going to be around $47 billion by 2025. So ideally, we would want to get into these stocks early, especially if they have fantastic fundamentals and financials, which I will talk about right now. Cresco Labs is a United States company that is based in Chicago, and they are a pot producer, and they have been growing very consistently while generating very impressive margins. Their adjusted earnings before interest, tax, depreciation, and amortization, also known as EBITDA, totaled around $56.4 million, which represents around 26% of their overall revenues, which is a fantastic margin. Their revenues are also very impressive because their revenues came in at about $215.5 million. And if we compare that to the company's success just a year prior, the top of the line growth was around $153.3 million, so clearly this company is growing and they're expanding their revenues, which is always fantastic to see. Cresco Labs anticipates to continue their revenue growth rate well past 2025, and currently they project bringing in around $235 million to $245 million. So again, we can see that their revenue has increased from around $215.5 million to their projected $245 million, which would be fantastic news. Also, the stock is trading at a very cheap valuation because currently the PS ratio, or price to sales multiple, is just over 2. And if we compare Cresco Labs to other cannabis stocks, Cresco Labs is actually trading at a much cheaper valuation because other giant cannabis producers are trading at around 4 times their price to sales, or their stock price compared to the revenues that they're bringing in. This tells us that overall, Cresco Labs has fantastic fundamentals, they are scaling their revenues, they have fantastic margins, and the stock price is trading cheaper than others in their industry. So to me, it could be a fantastic buying opportunity if you would like to expose yourself to this particular industry. So with their exciting growth prospects in sight, the current share price is looking very cheap and like a fantastic buying opportunity. But now let's talk about Shopify, ticker symbol SHOP. There has been continuous growth in Shopify's sector, which is mainly e-commerce. To put this into perspective of their fantastic growth, during Black Friday and Cyber Monday in 2021, there was about $6.3 billion spent on Shopify's e-commerce platform, which represents a year-over-year increase of around 23%, and it also doubled from their 2019 revenues in that same time period. But impressive growth is nothing new for Shopify. Shopify is rapidly expanding. They have grown their revenues from $389 million in 2016 to more than $2.9 billion in 2020, and their 12-month trailing sales have risen more than $4.2 billion. So as you can see, the company is massively scaling. They also have fantastic partnerships because they just recently announced a partnership with JD.com, which is a Chinese e-commerce site, which will make it much easier for Chinese companies to sell to Western markets through Shopify's platform. So this is extremely exciting because e-commerce is absolutely huge over in China, and people in China want to sell to the Western countries such as Europe and the United States, and Shopify is going to help them do that because of this partnership with JD.com. So overall, this is fantastic bullish news for Shopify. Shopify as a company is also fundamentally very solid because they are recording consistent profits and very positive free cash flows. So, from this recent stock price pullback that we talked about earlier, this could be a fantastic buying opportunity for long-term growth investors. Now let's move on to Walt Disney, ticker symbol DIS. Now, Walt Disney has a mix of investor sentiment regarding the stock. Some people are very bullish on this company, and other investors tend to not invest too heavily in this company, such as myself. Now, I don't think Walt Disney is a bad company. I am just personally waiting for them to recover more from the lockdowns and the current macroeconomic factors that are going on in the economy currently. And this has been reflected in their fourth quarter earnings report in November of 2021, which failed to impress investors and analysts. They missed their EPS and earnings per share because their adjusted basis was supposed to come in at about 51 cents per share, and it only came in at 37 cents, so that was a huge earnings miss. On top of that, the company has had a hard time scaling their subscribers for their streaming platform, which is called Disney+. The company added around 2.1 million subscribers, but management was expecting, along with analysts were anticipating, an increase of around 9.4 million new members and subscribers, so this was a huge letdown, which is part of the reason why the stock price has dropped so much. But since the stock price has dropped, this could be a good buying opportunity because now the stock is a lot cheaper. So Disney Plus is competing with Netflix, HBO Max, Peacock, and many other streaming services, so the competition is absolutely very ripe right now, and Disney is not the only one that is struggling in this regard. However, over time, I anticipate that their subscribers will increase at a very healthy rate because Disney is known for making quality TV shows and quality content, including their fantastic movies. Revenues from its parks, experiences, and products have also totaled around $16.6 billion, which is not too bad. However, if we compare this revenue generation from what they brought in around 2 years ago, it is a huge letdown, because 2 years ago they brought in just over $26 billion, so we have lost almost $10 billion in the span of a few years. However, once the economy fully normalizes, Disney could be a fantastic long-term winner and give its investors fantastic returns over the long run. And now we're going to talk about our last bonus stock, which is Honeywell. Honeywell, ticker symbol HON, currently trades at a stock price of $195. And I like this because it's trading below the low-end stock price target according to analysts, which is $200. The average price consensus is $234, and the high-end price target for the next 12 months for this company is $264. Analysts are also very bullish on this company because out of the 30 analysts that I researched, 2 say to sell the stock, 12 say to hold the stock, and 16 analysts say to buy the stock. We also have some great political news for Honeywell because an infrastructure package is soon to fully go through, which is going to help Honeywell, because Honeywell is one of the best industrial stocks that you can buy on the market right now, and another one would be Caterpillar, which I mentioned in a previous video. The company's largest segment overall is their aerospace segment, and the company's technology helps multiple institutions and even themselves build aircrafts, buildings, and manufacturing plants. They do this through advanced automation technologies and top-of-the-end software for their respected industry. Honeywell's aerospace segment is also expected to grow very impressively over the long term, which is why I personally own this company. While management hasn't given guidance for their 2022 revenue or their expected growth rate for this particular segment, analysts anticipate that their earnings per share are going to come in at around $8.97, and their free cash flow is set to come in at $6.03 billion for the year of 2022, and these are absolutely phenomenal projections by analysts, and it should make their investors extremely bullish on this company long term. They also landed a recent partnership with Freyr Battery to provide smart energy storage solutions, and the reason that they're doing this is they want to decarbonize storage solutions to help make renewable energy more accessible and efficient for their customers and any customer willing to buy this technology. So overall, those are the top 4 stock picks that I have for February of 2022. I'd love to hear your comments down below about these 4 companies. Subscribe if you are new. Remember to smash the like button if you haven't already, and I will see you in the next YT video.